Just like private equity firms, hedge funds are often shrouded in mystery, known for their ability to generate outsized returns, and sometimes employing very risky strategies. If you Google the largest hedge fund management firms, you can easily notice that they manage billions of dollars. Hedge funds are investment vehicles that pool capital from accredited investors to pursue a wide range of strategies aimed at generating high returns. Unlike private equity and venture capital firms focused on private companies, hedge funds play mostly at stock exchanges and other similar well-regulated markets. Yet, unlike mutual funds, which are typically long-only and focused on public equities, hedge funds can invest in a variety of asset classes, including stocks, bonds, commodities, currencies, derivatives, and more. The flexibility in their investment approach allows hedge funds to employ strategies that can capitalize on both rising and falling markets. From the organizational standpoint, it's the same approach used by private equity or venture capital firms. Hedge funds are typically structured as limited partnerships, with the hedge fund manager acting as the general partner and the investors as limited partners. The general partner manages the fund's assets and makes investment decisions, while the limited partners provide the capital. Investors in hedge funds are pension funds, insurance companies, ultra-high net worth individuals, endowments, foundations, sovereign wealth funds, and similar. Yet, just like with private equity funds, there is a catch. These funds use a lot of leverage, meaning debts, to even more enhance their specific investment strategies. However, the mechanism might be different. Let's explain. For example, if the hedge fund received, say, 100 million euros from investors, it can purchase securities worth 400 million euros by borrowing additional 300 million euros from banks and pledging them all, meaning 400 million euros worth securities. Those 100 million purchased from original investments, and additional 300 million coming from loans. That's called a margin loan, or instead of borrowing the money from banks directly, a hedge fund can use leverage through repurchase agreements. Here, a hedge fund agrees to sell a security to another party for a predetermined price, and then buy the security back at a higher price on a specified date in the future. In addition, leverage is provided by selling securities short and using the proceeds to purchase other securities, and through derivatives contracts that enable hedge funds to create exposure to an asset without using as much capital as would be required by buying the assets directly. In order to make it work, hedge funds employ a wide range of strategies to achieve their investment objectives. Some of the most common strategies include long-short equity. Hedge funds buy stocks they believe will increase in value, long positions, and sell short stocks they believe will decrease in value, short positions. This strategy aims to profit from both upward and downward movements in the market. Global macro. Here, hedge funds take positions based on macroeconomic trends such as expected interest rate changes, currency movements, or geopolitical events. They invest across a wide range of asset classes, including currencies, commodities, bonds, and equities. Event-driven. These funds invest in companies undergoing significant corporate events, such as mergers, acquisitions, bankruptcies, or restructurings. The fund seeks to profit from the price movements that occur as a result of these events. Quantitative strategies. There are hedge funds that use sophisticated mathematical models and algorithms to identify and execute trades based on the price arbitrage principles. These strategies are often driven by large amounts of data and can involve high-frequency trading. Distressed debt. These funds invest in the debt of companies that are in financial distress or bankruptcy, betting that they can profit from the company's recovery or from restructuring its debt. Here, it's very important to highlight that hedge funds often focus on liquid assets and employ a wide range of trading strategies, meaning they rarely invest in private companies. There are two reasons for that. They seek to generate returns regardless of market conditions, often through active trading, and they have to deal with potential money withdrawal. Let's explain. When establishing a hedge fund, investors agree to put their money in for a specified period. Usually, for the next 1 or 2 years, an investor is not allowed to withdraw the money from the fund. That's called the lockup period, and it's used to give a space for the fund managers to generate results. On top of that, certain gates are defined for the upcoming period. That means restriction for investors that limits the amount of withdrawals during a quarterly or semi-annual redemption period after the lockup period expires. A gate of 10 or 20% is very common, helping a fund manager to predict his liquidity and design investment strategies on time. Compensation is another interesting topic. Just like with private equity and venture capital firms, hedge fund managers are compensated in two main ways. Management fees. Hedge fund managers typically charge an annual management fee, which is a percentage of the fund's assets under management. This fee is usually around 1 or 2% of the assets, and it is charged regardless of the fund's performance. Performance fees. In addition to management fees, hedge fund managers charge a performance fee, which is a percentage of the profits generated by the fund. The standard performance fee is 20%, but this can vary. The performance fee is often contingent on the fund surpassing a high water mark, meaning the fund must recover any previous losses before the manager can earn performance fees. Finally, hedge funds are complex and versatile investment vehicles that play a significant role in global financial markets. Their ability to generate high returns, coupled with the flexibility of their investment strategies, makes them attractive to sophisticated investors. However, their higher risk profile, fees, and the need for substantial capital make them less accessible to the average investor.